Hi. When you trade Cardano, you buy and sell Cardano, you try to time the market and you want to be outside of the market when the prices fall. You want to be in the market when prices rise. When you do this kind of trading, what kind of moving average is the best to take? So say you've got the following approach. You want to be in the market whenever the price is above the moving average, and you want to be outside of the market whenever the price is below the moving average. It's a very simple, straightforward way to trade any asset and to try to time the market. But the question is, what moving average should you actually take? Because these moving averages, they average a certain duration, right? They've got a certain time frame that they use in order to calculate the moving average. So in this case, we've got, as an example, the 14-day moving average. And so you can change the duration, you could increase it, and then the moving average gets further away from the price and it smoothens out the price movements more. What I've done for this video is I have backtested all moving averages from the 2-day moving average all the way to the 360-day moving average, to find out, when you have the strategy of buying when the price is above the moving average and selling when the price is below the moving average, when you have that strategy, what's the best duration to take? Because there's basically a balance to be made, right? When you are too close, when you say have the 8-day moving average and you've got a lot of side movement, what happens is that you buy in when the price is relatively high, and then you would sell whenever the price is low. So you buy high and you sell low. And when you do this often enough repeatedly, you're losing money in this process. So those wrong signals over here create losing trades. Now, the good thing though about those short-term moving averages is that you exit the market very quickly when prices fall and you re-enter very quickly when prices rise. If you have, on the other hand, a moving average that's longer in duration, say the 200-day moving average, what happens is that you enter the market very late. So say you've got this rally over here, this 75% rally, you would have waited all of this price increase before you start entering the market. And the same goes true for the other way around. You exit the market very late and you take a, in this case, 46% loss before you consider the bull market to be over. So there's a balance to be made between being too slow in reacting to movements and thus missing out on all those trends, or reacting too quickly and thus making negative trades. So let's look at the backtesting results. There are two kinds of results that I want to present to you. First of all, we limit the maximum drawdown from the top to the bottom of our portfolio when we trade with using averages. So when you just buy and hold, in this time frame over here, we would have lost 76% from top to bottom if you just buy and hold and we don't trade at all. If we, however, trade and we exit the market completely when the price is below the moving average, what happens is that our portfolio line is completely flat. So we don't have this drawdown over here. So not only do we potentially gain more by not being in the market when the price falls, but we also reduce our risk. So we don't have to be in the market and potentially lose those 76% from top to bottom, but we exit earlier and thus our maximum drawdown from top to bottom is less. So the first result I want to present is how much less would we drop from the top of our portfolio to the bottom if we trade with moving averages. So here's the first result. What you see over here on this x-axis is the moving average. So this is the result of 259 backtesting simulations from the 2-day moving average all the way to the 360-day moving average. And what you can see here as the green line is the maximum drawdown when trading Cardano according to a moving average. So say over here, if we take one of those moving averages that are between the 40 and 50-day moving average, our maximum drawdown would have been less than 40% from top to bottom. Whereas here in white, we see how much we would have lost when we just buy and hold from top to bottom. So we can see that no matter what moving average we take here for trading Cardano, we would have in any case reduced our risk. So in most of the cases, if we exit the market when the price falls below a moving average, we would have limited our risk somewhere between 50 to 60% from top to bottom. So let me show you what I mean. In blue, we see our portfolio line. In white, we see the Cardano price. And in green, we see a moving average. And whenever the price goes below the moving average, our portfolio line is completely flat. So we are outside of the market. We don't win anything. We don't lose anything. And whenever the price is above the moving average, then we follow the market again. again. And what you can see is that when we are in bearish territory, when the price falls and we are outside of the market, we are not losing that much. So from the top to the bottom of our portfolio line, we got way less drawdown, way less volatility. So this is what this chart over here means. If you are willing to trade and not just buy and hold, you do potentially limit your risk exposure. So when you just hodl, in this case for Cardano, you see a maximum drawdown of 76%, but when you trade, it's better than that, independent of what moving average you take. Any moving average from the 2-day to the 360-day would have protected you somewhat from the downside. Now, you probably didn't come here to find out how can you limit your risk, but probably how can you make most money? What's the best performing moving average? How can you make most money? But before we jump to the next chart, it would be greatly appreciated if you could like this video so then YouTube shares the video to a new audience and the channel can grow. Thank you. So let's look at what performed the best historically. Here's the chart. Again, we've got all moving averages from the 2-day moving average all the way to the 360-day moving average. In white, we see the hodl line, which is equivalent to 312% per annum. That's what you would have gotten from just buying and holding Cardano. And in blue, we see the results of the moving average trading strategies. So what we can see here is that it does matter what moving average you take. If you would have taken a moving average that is very short term, say below the 14-day moving average, you would have underperformed just buying and holding Cardano. So Cardano is volatile enough to basically move around this moving average when they're too short to give you enough bad trading signals that you underperform buying and holding. And by the way, in this simulation, in this backtesting simulation, I did not account for trading fees, for slippage, for bid-ask spread, nothing of that. So we just look at the end of the day, we check what is the price for Cardano at this end of the day. We see is the price above or below, and based on that, we would lock in exactly that price and then follow the price movement. So that means these performances over here, they can't really be replicated one-on-one in reality. You need to account for those costs as well. But the reason why I didn't incorporate those costs is because by not looking at the costs, you get the pure signal performance. So if you consider other factors besides a moving average for trading, which is likely, you at least know what moving average gives you the best indication for future performance. And so when you look at this chart, I would stay away from moving averages less than 14 days when trading Cardano. I would only look above of that. And I would probably also stay away from all moving averages above 200 day. They also underperformed, and thus I wouldn't use them. The only advantage of using those moving averages over here is that you protect yourself from the downside. But this downside protection has the real price of creating less performance, and that's not what we want. We want less downside and more performance. So what are those best performing moving averages? The best one over here, that's the 45-day moving average, and that would have given us 420% per annum. Now, if you don't want to trade that actively, let's look at this moving average over here, and that's the 100-day moving average, which would have given us 383% per annum. So let's look at how the performance over time looks like for the slower of the two moving averages, the 100-day. So in green, you've got the 100-day moving average, and we are outside of the market when the price is below. We enter the market when the price is above. And when we buy and hold, which is the white line, we get 312%. If we trade according to the 100-day moving average, we would have gotten 383%. Now, this is interesting, right? This difference over here doesn't look like a lot. 312 versus 383, and we can only see this little difference over here. But what's important here to notice is that the scale here is logarithmic. So each step here is a 10x from each other. So what looks like a little difference over here actually in real monetary terms means quite a lot. I mean 60% per annum on top. Now let's look at the better of the two performing averages at the 45-day, which I think is probably also the better of the two moving averages to look at when you trade Cardano actively. Here's the result of the 45-day moving average. We see the moving average is closer to the price. So just compare this moving average here. It's very close to the price versus the 100-day. 100-day pretty flat, 450 much closer. And so just by looking at this backtesting result, we see 420% per annum. The difference is a bit larger here. And we do see bad trades. For example, over here, we got down with our portfolio line. but we also see we avoid big crashes like here, this big Corona crash. And so when you're wondering what's actually the maximum drawdown from top to bottom for the 45-day moving average, that's the one over here. It's less than 40%. So it does look like when you consider trading Cardano, getting in and out of the market, trying to gauge how is currently the momentum going for Cardano, looking at the 45-day moving average is the best bet you have. So here we've got TradingView again. In white, we've got the 100-day moving average. In red, we've got the 45-day moving average. And so you can see how they have behaved. Here we had a bad trade. The 100-day moving average isn't impressed at all. It just goes down. We would have entered the market here at similar times. We would have exited a bit earlier for the 45-day moving average over here. A bad trade over here though. And so if you look at the recent development, what we can see is the 100-day moving average is a pretty good support. We bounced off that moving average just recently on the 23rd of May. And we can also see the 45-day moving average is more aggressive. It does create bad signals, but if you're more actively trading, that's the one at least that historically worked best. So what are currently our support lines? We are obviously bullish. The price is above both moving averages. The 45-day is at 159 or 160 basically. It's increasing over time. So probably in a week we will be at 170. And the 100-day moving average is at 138. And so in a week, maybe at 143. So when would the market potentially turn bearish? It's if we would drop from here, maybe another 16% or so. So we do have a bit of buffer. But if you just look at the movements within the day, we came below those moving averages throughout the day, but we luckily always closed above it. So one thing to note is that the backtesting simulation was only looking at end of day prices. It didn't matter at all where the price was moving within the day. So you can't use those moving averages to set stop losses or to set sell orders because the price might go below and then shoot up again. But they do help for gauging general sentiment and maybe even as a way to determine potential supports. If you enjoyed this video, feel free to subscribe. If you've got Telegram, we've also got a channel in the video description below. Feel free to join. And last but not least, if you haven't liked yet, please like now. It means a lot to me. See you next time. Bye-bye.